There we go. We are officially recording. So this month, welcome to Grid Knoxville. We're talking about how to invest in apartments. And before we jump in there, the most important part is the legal disclaimer. Good, actually, read really quickly. Basically, what the state of Tennessee says is, as a real estate agent, right? I am licensed to talk about how to negotiate a sale and to answer specific real estate questions, and not very much else. I'm not an expert tax professional, I'm not an expert investment advisor, I'm not a home inspector, not a real estate attorney. Wants to make that very clear. All the information you get here is information for us only. Run it by somebody, right? And invest at your own risk. That being said, it's a really great collaborative environment. If you lose money, don't sue us. Right, guys? Awesome. Pros and cons of buying apartments. Before we get in, let's just take the temperature. Does anybody invest in multifamily? So we'll invest in multifamily. Anybody ever read anything about apartment syndication? That's something we can talk about today. Yeah, a couple people there. So that's another way to get into there. Anybody seen like Grant Cardone's been doing with like fractional ownership, where he's like, yeah, right?
Fundraiser.
I don't know what it is, but yeah, some version
he has his thing, but I've also heard the fundraiser thing.
Sure, yeah, it's akin to the same sort of thing. How do you pull your things together so you can participate in it? There's the advantages. So, pros and cons of buying apartments. Anybody got some preconceived? What are some of the cons about owning an apartment? You all can think of what's the downside? I'll start, right? I have managed multifamily, so we had a commercial property management business. I took over. We had an absentee buyer going through a lot of things, and so we took over a property for him, managed a 19-unit property with no funds on a shoestring budget. All the numbers were fake. Tenants were dealing drugs to each other in there, and then love triangle, trying to burn apartments down, bed bugs, every problem you can think of it. You know, all the problems that come from managing a single-family residence, just times 19. And then they're
in close proximity.
and they're impacting each other. So when there's a domestic incident here, like it impacts everyone else in the building. The pros are it's only one unit to go manage, right? So you get a lot of scale there, and you can do some really interesting things. And when you start turning it around, you're able to really add a lot of value. So we're going to go into some more detail in here. What this looks like. So. Here's the pros, the couple of biggest pros, right? So you can increase your income stream and your wealth faster because you only have one building instead of managing several single-family homes. You can diversify your risk. So if I've got a 19-unit building, right, and I have one vacancy, like I can handle that load. Like I can handle multiple vacancies, and I'm still going to cover my nut. I can still absorb some unexpected expenses, right? I can massively increase the value of the asset by adding value and raising rents. And that's what gets interesting because you start getting a cumulative effect, right? Once I start, someone comes out, I had to evict them, they're not paying rent. I totally renovate their place. I'm able to advertise to a more attractive tenant, and I'm able to get more rent. And then as I start collaborative, what I found is like the tenants that are living there that appreciate that, they're willing to pay more as well because they see that you're putting investments in, right? When they see you coming in here and you're like, hey, we fixed the laundry room, we're gonna address that, we're gonna reline it next week, and we're gonna have to raise, like, you wanna stay with us? Yeah, thanks. I love it. People want to live in a building that's well maintained. And there can be massive tax advantages for buying an apartment. Right? So these massive advantages in terms of depreciation, there's cost segregation, there's just a lot of advantages that come into when you get in there. As we all know, that's one of the big advantages of real estate, right? Is the tax code is totally slanted towards the real estate investor. It's one of those advantages that you can invest. Any pros I'm not thinking of? You guys, any questions? All pretty straightforward stuff. Yeah.
If you're a realtor, it's a good feeder system for clients.
Could be. Yeah. If you set up that way, as long as you get a good tenant flow come back in. Cons of buying apartments. It's harder to diversify your market exposure and buy a lot of them to costs. Meaning that it's hard to have multiple multi-family buildings. There you go. Thanks. Cool. So it's gonna be hard to diversify and buy apartments. That's one of the reasons why we talk about syndication, right? Because we were talking this before, it's great if you have the money to do it. But if you don't, you're gonna need to pool with other people because it takes a lot of money to play this in this case, right? Yeah. Turnover rates and operating costs tend to be higher. That is true, right? When you have a month, maybe you have 5 vacancies. Like there's you're gonna need more operating capital than just having one single family residence on a 12-month lease, right? That you can kind of plan around when it's gonna come. When you have multiple AC units go out, right? Or you find an issue that affects the whole apartment, you're gonna do a large scale capital outlay. Those can be higher, so you're gonna need more reserves typically. Cost of the asset is usually more expensive. Rewards typically gonna be more. It's a higher down payment. And if you're buying a unit that has, if you're buying a building that's got 5 more units, it's typically gonna be financed with a commercial loan, right? Anything, the sweet spot, if you're doing multi-family on a smaller scale is that 4-plex, right? You get that 4-plex, that FHA deal, put down only 3.5%, but one of the units, probably the best, the best mortgage you could possibly get on any asset. Use it over and over. I'm not blocking you down. Make me feel like my head's enormous. It is enormous, but right. So what that means though, if you get a commercial rate, is that your interest rate is only locked for 5 to 10 years, not locked for 30 years. So you think in this interest rate environment we're in right now, might give you a little hesitation, right? Well, where's the market gonna go? Flip side of that though is like rents are exploding right now. It looks like Wall Street is trying to move us to being a renter society and not an ownership society. So I don't know, the rents are gonna go back down. Anybody see the recent numbers coming out about rents in Knoxville last quarter? Our rents went up more than anyone else in the country
Really?
in the last quarter. Yes.
As a metropolitan
As a
area?
metro area, we were the highest, double the next closest area.
Shouldn't we have like absurd absorption rate too? Like,
Our occupancy rate's over 99%.
yeah, I thought it was like 99.5.
There is no room at the end. So the big question is affordability. It's not for us. I think the challenge is how do you manage growth? Because we're going to have growth. This growth is going to come. We're talking to the chamber about this. They're saying that for every applicant, there's 2 openings right now. Hey, Barry, so their biggest challenge is how do they actually keep them
I
here?
wouldn't have any trouble finding a new tenant.
No.
Hopefully, but they're-
Not right now. Is that what everyone's else is seeing?
Yeah, right. I just posted a 2-family for West Knoxville. And I had over 50 applicants over the weekend. Just the same.
What were the details? What were you asking?
2,300.
2,300, how big's the place?
5 bedroom, 2 bath.
You could ask a lot more.
Yeah. I had one in Maryville, 25 applicants, 2 days. The guy actually that wanted it said, I'll pay 300 more.
Yeah, I feel like the rental market is like what we were looking at the beginning of 2021 in the sales market, which I'll agree, just like where it's frenetic and it's emotion, it's whoever's willing to do the most is gonna get it. Yeah, so there's gonna be some serious.
Question is, can they afford it? That's the problem, because when you look at the finances, you're like, can they really afford that?
No, well, because I mean,
Nobody can.
rent is going up, it's got no correlation right now with increases in income or rates, it's just total scarcity issue. Yeah, definitely not sustainable. We'll see.
Well, because income's not going up that fast, that's for
No.
sure.
It's gonna be interesting, and before we go on there, if you track the numbers, they talk about numbers about affordability, the affordability index, right, which is just, hey, if you're paying more than a certain ratio, I think it's 30%, you're over leveraged, that number has gone up drastically around the country. That's the biggest challenge we're all gonna be talking about is really probably more affordability. It's not like, is the market dropping, or what's happening with interest rates with inflation? Where is everybody that works in any sort of normal, job you have in your 20s living right now? Where are they gonna live? Like, how are you gonna stay in Knoxville and not have to leave because there's no place to, so you can start your life, start a family, start a career. All right, so,
That's what renting by the room
yes,
said, right?
New York.
I got one.
you got a room,
I
okay.
got a room.
So,
I was looking at a statistic here from from July of 21 to today, credit card consumer loan debt has gone from 6 billion to 33 billion.
Holy cow.
Just one last sum.
Well, Wall Street is taking back, remember that, all those stats about like how Americans are sitting on the biggest cash surplus of all time? It is all coming back right now. Yep, it's all coming back right now. They're gonna try to run as many Black Friday sales as they can before people totally stop spending money in the spring, and they drop the real economic numbers. Yeah. All right, so let's talk about some good news here. So start off with just basic multifamily, 2 to 4 units. So duplex, triplex required. We just talked about this. You can use residential financing on these. It's a great way to learn the game. If you're young like Daniel, find one of these, right? You can go find a duplex, triplex, and live in it yourself. Right? Have a cash flow. That's the best deal in the game right now. You can get a regular 30-year loan on it. It's easy to refinance, and you can house hack your way to multifamily buying that, right? You're offsetting your residential income as well. So really advantageous. One pro tip though, if you want to do this long term, get them individually metered. Right? Because anytime that I've done something like that where it's not individually metered, you have to include it somehow, and you never end up charging enough, especially on these older properties. Right? I mean, if anyone's lived in an old house here in Knoxville and had one of those $4 electricity bills, you do not want to be. Well, your tenants will be calling you complaining about it when you come in to reinstate the house, but you don't want to be just on the hook for that the whole time. Okay, so as soon as you step over 4 units, and you get into 5 units, we're talking about real commercial multifamily. So this is going to require a commercial loan, and you need to put down at least 20% down on purchasing a multifamily. Minimum, right? The number check out to you, Will?
Yeah, I mean, statistically now it's more than that. They're wanting more now, but
Are they actively trying to reduce their deal flow? Like in that side, or is it just
No,
they're
they're
just
just
trying to manage the risk?
they're wanting to reduce risk is what they're at. I mean, I got an email today, update on some debt, and I mean, they're still very aggressive because it's a great asset to be in, but they're wanting, the days of 20-30% down are out for the foreseeable future.
What are you saying, like 35,
No, more like
40?
40-50. Yeah, they're wanting a lot down. And that now that's not 5 units. This makes up 80 plus units.
Sure.
But yeah, they're definitely wanting to de-risk a lot.
So your real estate asset is a business, right? So that individual multifamily, when we think about that, it is a business with a P&L. So my job is how do I create value in that business? So I'm going to minimize expenses. There's a couple of different strategies on that. I've seen some people, hey, I'm going to come in and fix all of it up. And then I'm going to try to market it to a different tenant that'll put less wear and tear on it. Right? Maybe different values, different audiences, different use cases, right? Or I've seen, hey, we're going to just do bare bones and keep it as it. What do y'all like to do? I like to come in and just I like to rent places that I want to live in personally. So sometimes I'm like, I can get by with laminate counters, but I want a nice clean place where everything works. And I don't care about the frills sometimes, as long as the functional stuff works. Anybody come in and max it out? Like to do really some bougie spots? You do, Will?
It just depends on the location. I mean, if you can come in and get a B or C location or asset in an A location, it makes sense because your return on your investment's huge.
I found we've been selling some stuff over in East Knoxville, wherever our Planned Parenthood was, which people would not think the name location, and maxing it out. I put over in Chill, how we put $11,000 kitchen in this place. We sold a 7. It's less than 800 square feet, sold for 185,000. It's a beautiful, beautiful house. I would live in there, but just curious about that. So yeah, you want to minimize your expenses, you want to fix it up, and you want to increase your rents. Right now, it's really easy to increase your rents. Like it's like tripping over yourself, but I am curious to see what happens long term. So let's talk about some basic numbers. We'll bring Will up here when we get done with this. And okay, so basic numbers to understand. This is we get into the math portion of this, for the next one, right? So the net income of the asset is what drives the value of the property. So what are you actually taking home after you pay your expenses every single month? Your job as an operator is just to drive that net up, that NOI, that net operating income. Right? That's all that matters at the end of the day. So here's a term you're going to hear a lot if you get into this space. You start stepping a foot into commercial real estate, or into commercial real estate terms. One of the biggest ones we're going to talk about is what's the cap rate. And honestly, it's clear. Some people that I hear use that term don't really necessarily have the same definition. I've heard it used a couple different ways. One of the biggest things to consider is just, are you actually including, sometimes it'll be like a cash on cash cap rate. There'll be a cap rate that's actually got like the debt service taken into account. So real simple stuff on how to calculate this. So if we're talking about cap rate is, you got an asset, you got a gross income of $40,000 per year. So that's how much is coming in from the rents. Okay. You got $5,000 in taxes. That's a fixed expense. You got $3,000 in maintenance. So you got to come in, replace a couple AC units. You're going to pressure wash it. You've got to paint it once. Well, you pressure paint it outside. You're doing some stuff there on the property. And you get $8,000 in insurance. Okay? You want to make sure you're properly insured, protect yourself from liability. So you've got $24,000 in net income. Now you'll be able to pick this place up for $95,000. So you're getting on your $95,000 investment, you're getting back $24,000. That's a 25.2% rate of return, right? Because you bought this thing just cash, straight outright cash. That's what you get back annually. So at that rate, 4 years, you've broken even on your asset. That's a great return. Right? What kind of cap rate are y'all seeing right now?
Sorry.
No, go ahead.
It's starting to rise a little bit. I mean, some of the assets we're looking at is 4 or 5. I mean, I'm seeing a little bit of 6. But it's very spotty right now.
Yeah, and we're going to talk about why apartments will take lower cap rates than they might take up on a single unit. What are y'all seeing on your single family rentals? What's your cap rate? 12%?
Yeah, I think that's like 10 when I do my calculations for it.
Yeah, and there was a time I'd be like, if I'm not getting 10% now, so I'm not doing it. The deals got a little tighter, over the last couple of years. You had a record, and now rents are kind of rising, even it's not a little bit.
So
Okay.
for those taxes, are those variable at all, right? Your rents change?
Are taxes variable? Your property tax? Well, it would be.
Oh, is that property tax?
Yeah.
I thought you meant like
No,
taxable.
No,
you know, on that
property
income,
taxes,
Right.
sure.
So is that a separate thing that should be taken into account?
Like tax.
Yeah, that 24,000, right, is taxable income.
Taxable income, yeah, but you're thinking about like how is the asset performing, because your tax load is going to depend on the structure that you use to offset it. So I think that'd be a step, like, hey, I have this income flowing in, is it flowing into an LLC, is it flowing into some sort of a trust structure, or is there some ways to mitigate that? But in theory, you've got multiple assets there, so you're trying to say, hey, how is this asset performing just like as a standalone asset? And then what do I have to do to like offset the taxes? That's a good question. And I'll answer that. I'm not a tax professional.
What?
So, here's another way to look at this. We're talking about income level, right? Thank you. Reason 2 to 1 too. Okay, so income level. If you've got going in the opposite rate, right? So if I've got a $400,000 property, and someone tells me it's an 8% cap rate, pretty straightforward. Just multiply the price of that property times that cap rate. It's going to give you the income. So we're going to get $32,000 in income and an 8% cap rate. It's the same way if you're looking at real estate stuff when you talk about months on, how many months do I have on market and absorption rate. They're inversely, one gives you one gives the other. In this case, when we have cap rate and income level, we have income level and cap. All right, so let's look at another one here, an example of how to find a cap rate. We got $9,000 in gross income coming in on top, which might be more what we're used to seeing if we're doing some single family, right? Something closer to that. We got a smaller place. You're using a property manager on this, so you're paying 10% every month. That's $900. You got a $450 maintenance budget. And then you got $710 in taxes. Insurance on this is $650. So your net income ends up being $62.90. You can pick this place up for $40,000. You're looking at a 15% cap rate. Yeah. So this will be a pretty small unit, but realistically, there was still, I'd say, until I was still seeing stuff maybe until 2019. I was still finding some stuff. I remember, you know where Lava Bakehouse is? Up in North Knoxville, just a little Happy Holler. There was all kinds of stuff over there. Even a couple of years ago, you can still pick up like, for under 100, just bombed out stuff, not anymore. All right, so. Any questions? I know we all love math, right? Yeah.
What's an ideal cap rate or range when you're talking to an investor that you want to stay in to make it like the most profitable for them, but would not be outrageous?
So you're asking Amber, right?
Yes.
Ask what's an ideal cap range where when you're talking to an investor, you would stay with them. I mean, obviously, the short answer is as much as I can get, right? But what you're gonna get when you work with investors, they're gonna be, hey, if it's, I'm looking for something with a 30% return. That's everyone. Like, I don't need to call you back. Like, everyone is looking for that. If I can find it, I'll get the money and buy it myself. Right? The goal that I've seen investors looking for is, hey, can I get a 10% cap rate? Depends on what I'm looking at, what the asset class is it a single family or like a short-term rental? It's been harder to hit that 10%. Do you agree on the short-term rental? It used to be like guaranteed, right? It was like, oh, for the 10% gross multiplier, right? Hey, if the property was marketed for $1 million, then it had 100,000 gross revenue, and then like it went insane here in the last 12 months.
It would have been the minimum.
Minimum, it would have been up to 20 sometimes. And it got to be, but they're still taking that. And I think it's because we started having people come from other parts of the country. We're getting 6% cap rates, and they're like, I will take your 10% cap rate, you're turning your nose up for it. Everyone's gonna come to that investor, like what they're looking to do. You still get 10%? Yeah. Like, are you gonna get, 20 or 15? Maybe, but not realistic. If you're new and you're just like hunting for deals. I would talk to some of the investors down here and ask them like, so I guess let's ask the room real fast here. What's the cap rate you would need to see to look at 10%? Everyone right about there, that's it. If you can find something that's got you agree. Something else. Surprise, do you trade Halloween candy with your friends? You bring in a trade, well, I'm about to start, a little candy brokerage going at the. Anybody else look at, what about on apartments? Those vary a little bit. We can talk about when you get up here.
Yeah, again, it just depends on its location specific. I mean, you got, depends on if you're in a primary, secondary, tertiary markets.
Usually when I'm talking to investors, the conversation looks more like, and I'll go back in this as the agent, it's just like, what's the long-term goals? Hey, come in here. There's a couple seats right over here next to Daniel. He doesn't bite. I'm like, yeah, welcome. Glad you could join us. Maritza?
Yes,
Oh, good.
we had the wrong address.
No, glad you're here. It's just having a conversation like, what's your strategy? Are you looking at cash flow or are you looking to buy? Right? And then you just, you present the deals and they can make a decision. Yep. So, all right. So cap rates and income level, basically we just said there, right? You know the cap rates, the income, and you can do this by looking at comps in a given area. All right. So a couple different ways to get that. If you are a resident, basically you need an agent that's got access to car seat. If we're looking at multifamily, anything more than 4 units, it's not going to be in the regular MLS. RC is the commercial MLS here.
CAR.
KAARCIA. What are we looking for? Is it just a commercial agent? We'll change the guidelines, but if you're not commercial agent with their MLS, you can't list commercial property. But there's probably plenty of residential guys that have access to that, right? I don't know, cost them money to get it. That's a full conference, right? All right, so this goes through what we just talked about, right? If we buy a property for $400,000 in an area that's usually got an 80% cap rate, is it really hot? Yeah, it's extreme. So we might find our recommended income level by multiplying that. just multiplying the purchase price by the cap rates until it's $32,000. You cannot set rental rates based off of your cap rate. It's not the way it works. It's gonna work based off of doing a rent survey. There's some third-party services you can use in terms of paying for data. Be curious to see, think the government brings class action lawsuits in some of these things, because the argument is, if you were doing this manually, it'd be collusion, so using algorithms to set rates is pretty problematic, but that might come down the pipe later. Or you can just call, same thing. This is what we're here for, is what's going on, what are you charging, what are you seeing rents are, right? Looking at what things are being advertised, what your competition is doing, those are all gonna give you an indication. How do you figure out your baseline for a different area, right? So you're gonna have very different expenses if you're managing a property in Tennessee versus managing a property in Florida versus managing a property in Minnesota. Right? In Florida, you're not worried about how am I dealing with license snow. Do I have a salt service set up, right? Do I have to worry about mineralized lines? But you are worried about, hey, am I adequately insured? My insurance is gonna be a lot higher. You know, I may have to do roof replacements more often, right? Because the insurance market's insane. Right? A roof that's older than 10 years, I don't want to insure. Right? AC costs are going to be significantly higher. So just working through, like, what does that look like? What's this baseline for my area look? So if I'm looking at this, probably the most important thing, and it can be difficult to get, right, is I want to see historical operating data. I want to see a real profit and loss for that, not just income numbers. Like, what are your actual expenses? What are you spending? What's your maintenance schedule? You know, if they don't have that, pay attention. If it looks too clean and there's no major outlays and that property isn't, you know, everything's not updated and new, like, pay attention to that, right? But you know, you being given a limit, and you want to get an idea of what the utility cost is. The total breakdown of this. So you can see if there's, and when I say a total breakdown, is not just a subtotal, you want to get that broken down by each individual utility. Right, say, hey, what am I paying for my electricity? What am I paying for my plumbing? And then typically, if you're depending on the complex you're running, or the size of the building you're running, you may have separate bills. Like, I was billed separately for like the parking lot lights and like the laundry room versus like the rest of that. So I want to look at that to see, hey, where are my expenses? Where can I save some? All right, so how do you get started investing in apartments? Couple of raise your hands. Who's interested in getting into multifamily, moving your raise your hands? Yeah, so quite a few.
Yeah,
Alright.
so I was wondering, what's the percentage of multifamily in Knoxville? I mean, it seems like Knoxville's more lower, you know, single family
Like, what
duplex.
percentage of units are multifamily?
Yeah,
That's a great question. Broker Rob, do you know
Say that again.
what the percentage of multifamily units are in Knoxville? Not many.
I know when I was looking for properties, I was initially looking at like, and they were all in Oak Ridge and Maryville is where they were located, so not even in.
So I don't know the percentage. I know it's very low. I know we historically have been stopping it. We got some zoning that prevents us from building multifamily here that everybody is trying to change because it's a tampering us.
Any place with historic overlay is taking multifamilies and turning them back into single families.
Yeah, there's a
At least
huge
national.
build off of Pleasant Ridge. Is that gonna be a multifamily apartment complex or is that gonna be condos? Does anyone know?
I'm just guessing, but a lot of complexes that are developed over there already.
Yeah.
It's historically a good condo areas.
So those aren't gonna be for rental anyway.
I
I
mean,
don't know, but
it'd be worth looking.
I think that's a country. I think it might be the apartments.
You think so?
Yeah, I was talking to some guys, they're talking about just how difficult it is to do condos right now because of just the insurance requirements. You have to carry so much, like, you carry so much trailing liability when you build a condo. It's like a 10-year span. Someone correct me if I'm wrong here,
Oh.
or if something happens with it because they're buying the interior, so you have to basically back the association. It's almost like giving a long-term builder's warranty towards the association, and no one wants to mess with that.
You get an insurance problem.
On condos.
Not the way that they did like 20 years ago. They set too much risk, so usually
Yeah.
So you're not responsible for that outside.
Or there's people that are doing stuff, they're building multi-families that could do a condo conversion. So you do the multi-family, and then if that building chose to convert, right, they could like self-form the association. I'm way out of my, I just know that that's a possibility, just different if it converted after the fact of the build versus you doing it in terms of like the build alone.
I think that apartment complex on Red Bud just did that. They converted over to condo and they were an apartment. Someone bought the apartment, fixed it up. Now they're selling them by unit
Well,
as a condo.
the condo association is homeowner rate that no one person has. The developer does under responsibility.
Yeah.
If you develop new.
Those are all apartments too.
The challenge with
Are they
those
the ones at the bottom of the hill?
On
The ones at the bottom of the hill? Is that what you're thinking about?
Red Bud?
Yeah.
I don't know, Red Bud just goes on a long way.
I have a
Yeah.
condo, well, it's got $60,000 outside improvements. Obviously that way too, so.
Knox Metro, Planning Commission says that there's only 23% of our housing is multifamily.
very, very low.
In terms of units, unit count,
Yeah, the mix of city and county, there's 37,000 multi-dwelling out of 143,000 total.
did everyone take the survey? Not planning survey?
Hold that thought. Okay, come back to it.
What is that relative to like a different city?
I just wanted
I don't know. I just looked it up, so I was curious.
Is that for your,
Like
That's
Denver.
for you?
It's good, usually some capital. So, pick an area that understands growth potential. You're gonna have some micro markets around here, right? Lenore City is gonna be different than Loudoun, it's gonna be different than, let's say, East Knoxville, where they're really trying to change the zoning and push and have some multifamily, do some mixed use development, right? You wanna find areas that are growing, so the good news is this is Knoxville, right? So we're looking at our jobs, our income levels, and our population growth. So what am I looking at if I want apartments? It's like I got some buddies that are developers. They put in a new Volkswagen plant down in Boudewell. They built a 300-door apartment complex, right next door. So, for example, Amazon got paused. We were working on a deal with a family that had 50 acres nearby. That's something we want to try to get zoned for multi-family. These track with jobs. They should, hey, people are gonna come here, where they're gonna live, Smith and Wesson, right? They also are gonna need homes. A lot of them are gonna be tenants. So it's kind of tracking where those jobs, what's going on with UT, right? And probably more student housing. But we're gonna have a record year next year after this football season, right? When the time applications they're gonna spike to be a big giant class, right? It's a great time to be in student housing. So looking at population growth, we're in a growth area. Right, we're going to continue to grow because we've got giant tax advantages. So even if we go into a declining economy, you're going to see, what you continue to see, is people are relocating here from other parts of the country, taking advantage of the fact they can work remotely or they can find jobs here, right? Because we're neck and neck with Florida for being the most affordable state in the country, right? Is that Florida? And Texas is also there in the top 5. If you look at the 10 fastest growing cities in the country, 5 of them are in Texas right now. Absolutely exploding.
So
So
the tax advantages, the no state.
yeah, we've got no state income tax. We're a very landlord friendly state. It's a good place to invest in. So you want to understand the cap rates. So typically, right, I would say if you're really looking to get into this, like sit down, talk to some commercial agents around here. Like get involved, learn this stuff. Don't just jump in, because the bigger the asset, you also have much more risk. This is not like unloading a house. You're like, I can just get someone in there, or I can move it, or I can still own it myself, right? Yeah, multifamily, really. They're trying to sell that building is not. You can get something big out of it. Okay, so you want to search for properties online. There's a couple different resources you can use. You can use the MLS, right? So you can get someone to set you up on a search, an agent or someone you know, plenty of apps. You can look on LoopNet. You can look on CoStar. Those are 2 of the national commercial, basically commercial MLS. Not quite MLS, but same difference. And then finally, I'm glad Will's here today, we can talk about this, you wanna line up the money. Where it's gonna take a lot more money to take on an asset class like this. Has anybody seen any multifamily, recently under 500K? Under 800?
Good question.
Yeah. Million?
I mean, pretty crappy stuff.
Yeah, I'd say we're well
It's
above,
on-
we crossed that $1 million threshold a while ago, right? It's like really to play, so if we're looking at putting down 40%, it's not a small amount of cash, not a lot of folks have that kind of cash that's laying around. Because you want to keep it used productively, so how are we gonna do that? We can use a self-directed IRA. Partners. 401K, use those savings, equity line, banks, or we can syndicate. Yes, dude.
Did you say you're looking at a correction just then?
No.
Okay, all right. It just seems peculiar to me. I mean, really, is a down payment 40 to 50%?
For somebody starting out, yeah.
I mean, look, it's never been that way in this country before. And if that's true, and I'm not doubting his word, we're looking at a correction or something because the banks are really, the lending institutions are really safeguarding their liability, their shucks, not gamble, but calculated risk. They really are. Somebody's looking for something funny to happen. Anyway, I just see a correction coming surely.
So here's what's interesting in Knox County, which statistics can be a little misleading. In the last month, we saw our inventory increase 50%. Does that sound fantastic to anybody? Anybody worried? Yeah, I'm not, because it went from 1.2 to 1.8 months. Right, so it sounds shocking. And next month, maybe it's gonna go up 30%, and it's gonna sound shocking. We'll still be under 3 months worth of inventory. I've been in real estate sales a long time, been in the industry 17 years. We're still gonna be in a record market. Doesn't mean there's not like a recession coming, or we're not gonna see layoffs, or something's gotta happen when you've got 25 applicants for a house, right? That's gonna start showing up someplace, probably in food banks, and it's gonna show up at our rate. I saw a big thing, Thanksgiving this year's gonna be interesting, food's going crazy up, but I don't know that it's in the real estate market because our market's so different. When I'm looking at Vegas, their market dropped 60% in a matter of months.
I've heard
The
across
days on
America,
market are way up.
with the exception of Texas, Florida, and us, there's already been a 25% reduction.
Yeah, and so I think that's the weird thing we're trying to figure out is how do we not be overly optimistic? I don't want to tell anybody to go, by all means, I got no crystal ball and I lived through one crash. I was a mortgage broker in Tampa during the last crash and we lost 37% of our income overnight. And by 2011, that market was 90% foreclosures. But I don't know that like Tennessee, Florida, or where that's happening necessarily.
I can tell you, we just moved from Naples, Florida,
Yeah.
and to here to invest here. And I think every real estate market is market specific, because even in Florida, we're in Naples. If you guys know Naples retirement, you know, like this is where the rich people go to retire. And it's very different from even 2 cities over. So as long as you really know your market, then you will understand what's happening.
I would just look at that stuff. That's my advice is just, you're all really intelligent people, just get some local data, like the hard data, and just compare it to like the national trends are, and you'll be able to see like, okay, we're moving in that same direction, but we're 5 months behind, you know, so I can kind of act appropriately. But we've got tremendous growth. Anybody worried about the bottom dropping out here?
I was gonna say, something to keep in mind there is, even though your local market is really strong, the lending market is national. So you have to, we may be really good in Knoxville, but they're looking at the big picture.
And then I've got a lender on here, right? So she lends nationally. I don't know, Eric, if you're licensed in all 50 states, I think you guys might be. Just like, there's no 100% financing, there's no subprime financing, right? Appraisals are dictated by actual value. Because the market, when the market goes crazy, stuff gets hinky. I guarantee we're gonna find out in 3-4 years, all the weird stuff that happened in the last year, right? When money was just flowing and deals were coming, right? Foreclosures increased at the beginning of this year, like I said, only because there were foreclosure restrictions, COVID times. And only the biggest markets you're seeing in Boise, Austin, and Phoenix are seeing large declines in value. Boise is really fascinating, right? So if you look at, there's a newsletter called Y Combinator, which goes towards like, it's really geared towards like venture capital, startup funds, things like that. Like if you want to go get venture capital, this is your kind of this newsletter. All of this funding got cut off. There was all these layoffs, and there's a website, layoffstracker.org, which I would check. That's going to tell you what the recession is doing. You should watch layoffs. Those turn into actual like effects in the economy. They're totally correlated, directly correlated. And what happened is all those layoffs happened in Silicon Valley, and then there was 300 cancellations of new construction purchases in Boise, Idaho. Because there was a direct correlation between, right, Boise was becoming a new tech hotspot, and these guys were spending all this money. Yeah, Tim.
Speaking of layoffs, I have several customers of mine that they're getting possibly laid off. Some are in the tech world, some in printing, some are just in different fields. They already got emails and notices saying, hey, we're doing, laying off some people. They haven't, I've only had one customer tell me that's luckily they're not in the group that's being laid off in their company. But right now, the companies are some companies are actually looking to lay off.
Are those national companies or local? And they're,
One of them I think is national, and the rest are mainly local.
Has anybody heard about, I haven't heard about any large scale layoffs?
No, it doesn't seem like it's large scale. It seems like it's gonna be like little niche groups. Like the one that I got the most information out of is a printing company. And it's mainly due to the fact that not a lot of people are actually reading physical prints anymore.
Gotcha. Yeah. But it's funny, I was thinking about this, I was talking to, who's been around, I was thinking about Judy Starloper the other day. I don't remember Judy, but when I first came here in 2010, a big part of real estate marketing was like laying, I used to work with Lucas on laying out our spread in the Knoxville Center. What we're gonna put on there, how we're gonna lay it out. Oh, she's doing really well, she's got 10 pages. And that totally evaporated in my lifetime, right? So how do you get started real fast, guys? And I'm gonna bring Will Morris up here, just to talk, we can ask him some questions about syndication, about how to invest in apartments. He's a great resource. So hire a broker that specializes in multifamily and consult with them what you're looking for. I think that's just a no-brainer. The degree of difficulty gets higher once you get into commercial and multifamily. When we're doing, residential, lots of investors feel comfortable representing themselves in purchases. They've done it a lot of times. Not so crazy when you're doing multifamily. Get a broker. You're gonna want that, and you're gonna need a strong broker to get that info for you. A third party to dig and do the due diligence, because the due diligence on these things is where like you're gonna make or break the deal. Right? So you want someone like, again, if I'm shopping for this, if this is kind of baked into like the operating expense, go hire someone who not only like has the contacts, but has the institutional experience, can guide you through and say, hey, those numbers don't add up. Like those numbers don't. For that place, there's no way that cap rate's accurate. Just go drive by and look at it, on Friday night. That's not, there's no way it's capping that, right? Call property managers, tell them you're looking, talk to contractors. Start building out your dream team. We talked about in other months here. Who's going to help you fix this place up and get it on track? Drive for dollars in your target area. You can send out letters. You can look at absentee landlords, especially if we're looking for smaller multifamily, right? Hey, I'm looking to pick up, let's say 5 to 10 units. Maybe I'm looking to get a portfolio, some duplexes or a mix of like duplex, triplex. Cory's selling something right now. I think it's 18 units. So it's a portfolio. This guy's bundled together, something like that. Make offers, analyze those deals. So we've got, if you don't have them, I can get you a good deal. Analyze the grid put. Well, they're going through grid Asian investor certifications. You can run these numbers. Secure the properability with the feasibility study. You run feasibility studies, Will? What's a feasibility study?
Basically, if it's a good deal or not. Basically.
So you're gonna look at some demographics, right? You're gonna look at some potential challenges, look at what's the potential. So let's say if I'm buying, we talk about these properties as an A, B, or C. Hey, if I'm buying this property as a B property, the plan is trying to make up some A-class property, right? Well, what's my ceiling? Like when I look at everything else there, what's that gonna, where can I get in terms of revenue and what would I do to get there? Run those numbers in the front. Closing the deal. So you bought an apartment building yet? What are your next steps? To execute the business plan, as we talked about running this like a business, and this is where if you want to have a business plan to execute, and have turned around a building that was in disrepair, you want to be able to come in and tell them, here is what you're going to do to change this property and communicate this clearly to your tenants. The difference with doing this versus other businesses, you have people that are actually living in, your asset that you're gonna have to cooperate with to make improvements. So stabilize the property. First thing I want to do is get in there, stop any bleeding, figure out who's actually paying, right? And I want to start adding value by updating the units that turn. That's one easy way to do it is, hey, every time a unit turns, that's the one I want to come in, I'm going to fix. Okay.
Hey, another thing too is like if you don't have any experience writing a business plan, if you go to Greater Knoxville SCORE, there's like 50 business mentors. It's a nonprofit. They're located off Cedar Bluff, and they will hook you up with someone who will help you write a business plan for your
Thank you.
venture.
That's great advice.
What was it called? It's SCORE Greater Knoxville. It's Greater Knoxville .score.org.
Yes. So SCORE, and correct me if I'm wrong, because I've talked to them a couple times, I met people that are in there. It's someone who's like, hey, someone in this room, right? I've got some experience, I've been doing this 20 years, I'm a small business owner, but I like run like a plumber. I'd love to help somebody. They get involved in there so they can mentor other people.
It's
And they,
retired executive.
Yeah.
yeah, you get fantastic advice. They will come in and sit down with you and walk you through.
And if there's something like really specialized that you want to do, they'll hook you up with someone that you can Zoom with nationally.
Yep. The other thing I would say is get on grid. If you're an investor, I know a lot of people. My buddy Jason McDaniel that runs an investor meetup next week is the same way. I know local investors here who are willing to actively mentor and help other people get well from this. Right. But yes, good advice, Matt. Do not do this on your own. Improve the curb appeal of the property and change the tenant profile. What's your favorite way to improve curb appeal?
Clean up first, all the weeds, all the dead plants, get those out and put in one
Landscaping.
type of.
I think so too. I think landscaping is like the single biggest thing you can do. Like to just add value to those tenants. Right? Again, when they come home, it's make a big difference. But now there's some flowers there. Like I smile when I'm at my front door. Right?
There's trash on the ground, no trash.
Yeah. No, 100%. People adapt to what they see. Yeah. Which we all do. I guarantee all of us acted different at grandma's house than we did at home. Right? Because it's just different rules for different places. You do too? Yeah. You crazier grandmas or better? Okay. So, and change the tenant profile. So what's the tenant profile? Maybe I'm looking for somebody that's more qualified, maybe I'm looking for someone that's more reserves, and looking for someone that has a better rental history, right? I'm not people that have prior evictions or history of late payments, things like that. Yeah, hard credit score. The drugs? Yeah. Exactly. Want to raise rents, look at the new cap rate, and then my exit strategy is gonna be one of two things. I can burn that property or I can sell that property. And I'm gonna defer to, we'll get to here to talk about that exit strategy. It's gonna be, that's a nuance I want to get your input on. All right, any questions before we bring Will up here? Want to save it for him? Okay. Sweet, Will, want to come up here? All right, let's have a conversation with that, so. I'm gonna put your picture up here.
Oh, nice.
Yeah.
It's not even wearing a sweatshirt.
Against the devil. All right, so This is our friend of Grid. Will, tell us a little bit about yourself. Just real briefly, 'cause you've been here a couple times before, you might have heard talk about it. What do you do day to day? What was your background? Just kind of generally what you're doing. We'll start talking about how you got into investment funds.
Yeah, so just a quick, I guess, background is, I started out as a general contractor several years back and got a chance to do a rehab on an apartment complex locally here. That led me into growing that, and doing 400 or 500 units, and then that I started another business, importing cabinets, hardware, different things. Which ended up doing over 3,000 units nationwide. That led me to meet some pretty big owner operators, investors. Trying to get into syndicating, and I actually failed at syndicating. Was successful with it because I didn't understand the full facets of what it takes to syndicate. But what I did end up doing was raising capital for somebody else's deals. The piece I was lacking was experience. Believe it or not, debt experience is what is the driver for debt on these assets. Because they pay their own debt, right? So if you got a self-sufficient asset, really the only thing that can screw that up is the operator. And so that's the reason why they focus so hard on experience. And so what I did is I said, well, I've got these guys that, they're syndicating on operators. I said, what if I just was to help you raise some capital for your deals, put me in on the general partnership, give me some experience. And so that's what I did. I was able to help them do that. I was able to get GP experience myself. And that also led me into investment funds. So I started raising my own capital because I found out I could raise capital. And so launched my own private equity fund. First one about 4 years ago. We've got 3 active now, and launching another one. And so that's basically what I'm doing now. Awesome, fun, man.
So what got you interested in apartments? Was it just exposure to it? It sounds like you got exposed to it kind of incidentally from doing just your other lines of work.
Well, yeah, so one is kind of, that was the genre that I was in, that was the space I was in, but also once you start researching it, going back to like his sort of rebuttal is that it's actually one of the most safest asset, my opinion, safest asset classes out there. Through recessions historically, they've well performed, easy to value add to create that forced appreciation. Once you start digging into this, I would implore you to look into like the cash out refi. It's technically a non-taxable event. And so when you go in, you buy something for 2, you add value, refinance 12 months later for 4. You do a 30% cash out refi or something like that, and that's all right in your pocket. So that's pretty nice.
So you're able to free up more capital as you go along, right, without having to incur the tax.
And leverage too, like leverage is great. I mean, what else can you buy? Typically 20-30%. I say 40% is for non-experienced. You can still get, they've got bridge, mezzanine, you've got prep equity. There's so many ways you can do what they call a cap stack. And so, I mean, you can get by with minimal down. It's more risky and you're giving away more of the pie. But there are ways to finance these things. So leverage, downside risk protection and forced appreciation, I guess, and then just being exposed to it.
Right. So we've mentioned probably 4 or 5 things, and then we can all unpack. And I'll be the one. So, anybody have any questions for what he just said? Talked about bridge financing, mezzanine financing. You talked about forced depreciation. You talked about cash out refi being a non-taxable event. Anybody have any questions?
I have questions about the loan types, right? So the bridge, all the ones we said. Can you explain that?
Yeah, so conventional is going to be like your standard, 10, 15, your big boys. Bridge is typically a 2 to 5 year. It's more of like a just get it acquired type deal. Bridge means that it bridges you from acquisition to permanent. And a mezzanine is like a mezz debt is similar to like a hard money, I guess would be the way to say it. It's not as expensive as hard money. But in the commercial world, that would be the hard money, I guess would be the way to say it. And so you could do if you could get, say, a bridge debt for the acquisition, that would give you, say, 3 to 6 months, or I'm sorry, 3 to 5 years to refinance it out. But say even with the bridge, they'll only do, say, 70%. and you've got 10% down, you may have to take on some mezz debt for that 20%. To where you can get by with the acquisition of a 70% bridge, 20% mezz, and then you bring the 10%.
Got it.
So it's just layers of stuff. But like I said, each time you do that, you're giving away pieces of the pie. So they get paid very well.
And that really good cap rates may call it worth great.
Yeah, I mean, or just a good cash flow. You gotta have a good pro forma. Pro forma is something I noticed that wasn't, I mean, it was kind of in there, but that's something that they'll want to see. A pro forma is basically a projection, saying, hey, look, we're at $400 a month. We think if we go in and do this, and this, we can get it up to $680 a month. It allows you to kind of project what your income will be.
So a pro forma is basically like taking, if you've done an itemized P&L and doing that off a projection. What's this, in a year, what are my numbers gonna look like? Once I've improved this thing, because it's nicer, but also my maintenance costs are gonna go up because I'm gonna maintain to a higher level. Or I've added some, my insurance costs are gonna be higher, or I've added some amenities that are gonna cost more, right? Yep. Or there's debt service, whatever that is, right? Yeah. So that'd be your pro forma.
I'd like syndication explained better. I don't really know
Okay.
anything about that.
So I was thinking about this this morning, and so a syndication. So let's say you've got you want to buy this building we're in. 10 and say you have 10 people that come up with that equity piece to buy this building. Well, you guys can do that as a syndicate. It basically means to syndicate something means that multiple people come together for one singular common cause, right? And so you could do that in just a partnership. That would technically be a equal voting right syndication. So you do that, everybody gets in, by everybody signs on the debt. But when you become when you come into syndication in the form of we all hear like what grants do and all this stuff. What happens is when you say, okay, out of these 10 people, 3 of us, let's draw a line on 3 and say us 3 are going to become the active investors. And we want the other 7 to become limited partners or non-active. And so when you do that, you're technically selling a security at that moment. So then it opens up into what they call regulation D, private offerings. You can be a 506B, 506C, depending on how you're going to market, how you're going to raise those LPs. And so, and there's also, you can, instead of 7, now you can have 7 people want to. You can go but that's basically a syndication is just think of people coming together for a singular focus. That what you have to ask yourself about is really what I call sort of like your proximity to capital, your network. If you know 10 people with $1 million, then you go, you go get it done, right? But if you don't, then you have to look at, okay, how am I going to structure this to be able to raise that equity piece, that 40, 30, 20%, whatever, in order to make that acquisition. That help a little bit?
Yeah. So when you said you failed at it, how many were in that partnership and what was their experience level?
I failed because I didn't, if I had it to do over again, I would network with experienced partners. And I would actually do more of a JV, like a joint venture in some capacity, bringing them deal, bringing them money, bringing them investors, bringing them some sort of value, because I didn't understand the debt component experience. I'm sorry, the experience for the debt. I didn't understand that. And I went out trying to raise capital thinking that I could just, make 4 posts on Facebook and that, I would magically get $4, $5, $6 million. But, surprisingly enough, anybody with sizable liquidity is actually pretty smart if they're not to know somebody. And so they, they're not just going to give you money because you made a post and magically have a deal, especially when deals are kind of plentiful. So that's why I failed at it, because I was like, yeah, I can do this.
So you say you want to go back, joint venture with somebody, leverage their experience and their authority in the market, where you can say, hey, I'm working with David. David's been in the industry 15 years, or I'm working with Will has all this experience, right? I'm going to learn here. I'll be able to say I participated in this deal as an active partner.
Yep. And you can get participation in the deal. So you may not necessarily get any immediate cash off of it, or but you possibly could get cash flow. You could get equity in the refi or the capital event, whatever that may be. And then ultimately you could get the, if you get in on the GP and prove that, then, joint partnership, you can get that experience, which that's worth its weight in gold when you go to the bank.
How much capital do you think you have to invest
In what capacity, as far as singular?
It's a sum of both, like, as an individual, if I wanted to participate in like a joint event, or if I want to go take down an asset, like how much capital do you actually need to take down an asset?
I mean, you're gonna need your minimum 30%, plus, if you're by yourself and you go out and you say you found a plex or something like that, my experience, you better be banking on 30% liquidity, a net worth equal to the loan amount. So, if it's, let's just say $1 million, you're gonna need 300,000 down and 700,000 in net worth in order to buy that yourself. But if you want to get into bigger deals, syndications, when I was first started out syndication, I didn't put any money in there. I brought equity, sweat equity, and I brought the deal. I'd go out and raise capital. Is how I got started, really. I mean, but as far as if you want to get in on it, if you're bringing other, say you've got a little bit of liquidity and you want to say 100 grand or something, like you can piggyback, so that's a great way to kind of maximize the way you're actually kind of on both sides, LP and the GP side.
When you say piggyback, you meaning you're speaking as the syndicator.
Yeah.
So I mean, you're the person you found this deal. You found somebody that was, hey, he's off market, he owns an apartment complex, he's sick of this, he wants to sell, so he goes to these. Right, find me a buyer, take this thing off my hands, I don't want to mess with it anymore. So you say, hey, well, I'm gonna try to go find someone to find a buyer that I can come just as, hey, I'm the organizer of this thing. I don't have the capital, so you try to do and fail because that's gonna be a hard sled.
And I was going after large assets too, which is looking back. I mean, I personally wouldn't start less than probably 15, 16, just because you get the economy of scale, like you said, your occupancy,
15, 16 units.
Yeah. Because your occupancy starts messing with you when you get below that. But I mean, I was going after some big, 100%, 100+ units.
Jason Wells. Hey, I'm gonna hit a grand slam right out the gate and be done, right?
Yeah.
And what you were saying, you piggyback off it, meaning, hey, if I'm organizing a deal, plus I have my own money in there, then I can also it can be one of the GPs, right, where I'm getting paid as an active investor, but I'm also just investing like another LP, like I bought one of the syndication slots.
Yeah.
Got it.
Two questions. Number one, when you're talking about syndication, is that only it will be done on a commercial venture, or could that be done to essentially put like a piece of land into a conservancy or form a nonprofit, that kind of thing?
No, you can do it for anything. I mean, I started out doing it in real estate. We're now syndicating business acquisitions. That's actually where I spend a lot of my focus is in private equity right now. Just because in my space, the real estate got, we're in a transition. The next 12 to 18 months is I'm looking to hammer down on real estate, but not right now. And so, no, you can do anything. You can do land, you can do real estate, multifamily, single family, 10 multifamilies, a portfolio. You do anything. It's just as long as you structure it in the operating agreement stuff.
Okay, cool. And what are the pros and cons of a cash out refi versus the HELOC?
Like on a house or like in any of these assets?
Like a house, yeah.
Maybe they're on that.
Can you do a deal on a commercial? That's fine.
I'd say the pro of the HELOC rate is you're only paying interest on the money that you're using.
Right.
So if you cash out all that, if you don't have something to use that cash for, and especially in an inflationary environment, you could just be paying money on, just to have a security of sitting on cash. The downside would be is that HELOC, if things tighten up, they can cancel that. They can call that, they can make it where you can't draw on it, so you could lose access to that capital in the future. Beyond that would just be interest rates, and everyone else is sitting on it. Those are probably the biggest.
It has to be a primary residence too.
Yeah, those HELOCs on investment properties, those were around for a while. I know a guy still sitting on one.
I got one on a second.
You can get.
I got one on a second home.
Yeah.
Lower closing costs. On a HELOC, you
Yeah,
can get them for
that's-
practically.
Yeah.
So.
And they're a great asset to have, like, if you're thinking about flipping or doing
I mean,
anything,
that's what I'm doing right now.
it's like having credit cards, right?
Well, what's really nice, if you want to buy your property, and you're gonna turn into one of buy another, you take you lock on it when you live there.
Yep.
And then they can't take it away, then you move to the next. And you keep it down.
I have a question with the syndication. So if you're gonna have limited partners in a deal, you have to do a syndication, but is that what I'm understanding?
Yes, because you essentially are creating an offering, a security, whenever because the reason why, and you have to register under, under the Reg D, which is a private offering, and the reason why is because it comes into the Investment Company Act, it falls underneath that, so, because at that point, you're basically investing on their behalf, because they are limited, they technically have no voting rights.
So if everyone's a GP, it doesn't need to be a syndication.
Correct, I mean, you can do an operating agreement, you can have 10, 15 different people on there, it don't matter. But they're all voting at that point too, so keep that in mind.
Yes.
Right.
Yeah, but just kind of piggyback off that. Those, the silent investors or the passive, what rate of return do you typically see or they looking for?
It all boils down to the asset. I mean, if private equity, we're paying a heck of a lot more than we are in multifamily. But you also have your risk and return profiles. And so, that's one thing I try to understand when I'm talking to investors. I don't really ask them how much or whatever. I'm looking for, what's their risk, risk profile, what's their investment horizon. That's another thing, like big time for us right now is multifamily, for example, you're 7 to 10 years in these syndications and these funds. And so, it gives us time to, make acquisition, to go through the value add, to stabilize that, prove that, and then refinance or sell. Whereas more private equity, I mean, we're 3 to 5 years in and out. And so, we're talking to our investors and they're, man, I don't want to be tied up too long. It's okay, well, look at this. Or if we have a different, because we got one opportunistic fund that is a shorter, investment horizon for these investors. So they can, you kind of shuffle them around. You want to learn their goals to where you don't ever want to try to, in my experience, you don't want to try to fit an investor to the investment. Does that sound right? You want to fit, in my place, like in a fund, I don't want to take investor and try to make them fit inside the fund. I want the fund to fit the investor. Does that make sense?
Yeah, you want them, if they're looking for a higher return and they have a higher risk profile, maybe they want to invest with you. And hey, we're going to go take down a business.
Right.
But the downside is, like, we got this landscaping business and then it all went, and we're stuck. We've got 30,000 in mowers as opposed to like, oh, now that's in terms of like assets we can sell off, as opposed to, hey, I take a lower rate of return on these A-rated apartment rentals.
Right.
But it's safe.
And that's the reason why apartments have gone through the roof too, is because a lot of the Wall Street, pension funds, endowments and stuff, they started rushing for a safe investment. They want somewhere they start looking at capital preservation and a hedge against inflation more than they are looking at returns. So I mean, it's in some sense, you say, what kind of return do you expect? Like, we don't want a return, we just want to keep what we got. Sure. For the next 7 years.
What's interesting, to that point though, is that I read that article about the possibly what's the word I'm looking for? Gosh, collusion. The collusion with this rental software is it's all giant conglomerates. If you look at like Greystar, you look at all these apartment management companies, it's giant conglomerates. There's a reason why.
Manipulate the market, yeah.
But it's the same thing. This is giant institutional money. We've got a system in place. When this works in Topeka, we can bring it to Knoxville to work, and we've got this distributed because we 20 different apartment complexes, right? So this is major institutional money, which is probably why we were talking about those cap rates before, 4% to 6%. Is that on? Are we talking about more than 50 units?
Oh yeah. Like I lost one back first of the year. I lost one in Chattanooga to the ex-CEO of WeWorks, and it was the lowest cap rate I ever offered. I think I was at like a 4.2. He come in like a 3.8, 3.9. All like, I said, he can have it. So he ran one company.
Sure, but also if that investor is looking for, you understand we're talking about like stabilization. If you're looking for a place just to park your cash, all these guys were liquidating their cash because they say we don't have cash in an inflationary environment because the cash just diminished, right? Over and over. We're just going to buy real assets. If we can buy a real asset that's secured by rents, not only, so our cash is safe, that's gonna go up. And then in a recessionary environment, rents are kind of locked in, right?
They're not going down.
The rates
Yeah,
and the
yeah.
low with inflation.
Yeah.
So earlier you said about diversifying your investments. Are your funds, are they just real estate, or how diversified are your various funds?
I've got 3 funds, and then we're launching a growth equity fund right now. And then we do syndications all the time. Syndications are just kind of one-offs for us. Whether we get brought a deal from, say, a family office or somebody, like, we joint venture with a lot, and we do syndications that way. Sometimes we'll find a random deal that don't necessarily fit, because when you have funds, you have to kind of outline the parameters, and you don't really want to get too far outside those parameters. So if you have something that don't necessarily fit inside one of those funds from a strategic standpoint, we'll just roll into a syndication and do it.
Don't have a unicorn.
So what's the difference between, let's say, if I'm as an investor looking to invest, between investing in a syndication versus investing like in a real estate investment trust?
Mhm.
Or just buying like a traditional security?
So a syndication is singular asset focused. So like we're buying this property, this is the offer, this is it. Like when you buy into this thing, like you go take a leak on that, this is yours, right? And then a REIT is actually paper. So you're buying you're basically exchanging your investment for a piece of paper, a stock, if you will, of multiple assets. A fund is kind of in between those, because we're buying physical assets. You still own physical assets, but we're taking your 100 grand and we're going to diversify it up between 5 properties, 3 properties, or something, whatever the size of the fund is and the acquisitions. And so it's kind of, a fund is in between those two.
Yep. So that REIT is basically, you're getting, it's more formalized, you're getting a chunk of.
And a REIT's public too, I think REITs have to be public, if I'm not mistaken.
Yeah, like is the prospectus public on a REIT versus a fund?
Should be, yeah. Like I operate everything so far underneath the regulation D, which are private offerings. We'll either do a 506B or 506C. Depending on if we need to market or not. But
The advantage of syndication, my understanding, we're talking about this, is I was looking at, what's really interesting is if you can go look at the legal digest, you can look at the digest for, let's say, Florida has one, Tennessee has one for realtors, and they'll give you these case studies. It was talking about a case study of a condo where the developers got sued for selling securities without a license, because what they did was somewhat similar to this, right? They had like voting shares and then Class B shares, but they weren't properly securitized. Like they
didn't register.
They didn't register it correctly to do this thing. What ended up happening is like the project didn't go off. And they were either blowing through the money or they were getting a salary, just go off. And then those Class B investors were suing to get their money back because, hey, they didn't have a say in this. You guys are all Will's voting for me to get, 30 grand, market salary, and like it doesn't go through. That I think is kind of interesting. Syndication gets you around that stuff. So just be aware of that as you're getting into this. Like, I think the joint venture, talk to someone that knows what they're doing. There's ways to do it that are totally legal. And you can also, if you don't do it correctly, you start securities on license.
Yeah, starting over, like real world advice, I guess, if you really want to get into it, I either find people with money and you bring them to something that you don't have to do me, but I bring them to me, and then you can get, you get a piece of the deal in exchange. You basically, or you can find a good deal. Find a good deal, bring it to me, and if we end up doing it, then you get a piece of the deal that way. And so you really like to do that like once or twice. Once you get that, then you got a track record. You've got experience, then when you're talking to that investor next time, or the second investor, third investor, and you say, yeah, I'm part of a 58 unit syndication, and oh wow, okay, so how's that going? So been in it for 12 months, doing really well, or vice versa. You find a property yourself, and you're going out and you're going to raise your own money, because really a lot of this boils down to track record. I mean, that was the hardest thing for me, was building that track record. To be able to show that you're not, you know what you're doing. Yeah, you're right to show.
Any other questions we haven't talked about investing in apartments, about investing in multifamily, challenges, property management?
Why do commercial buildings try to sell you on pro forma instead of the actual value?
So they, like, I mean, you know the
Yeah.
numbers, 'cause they give you the rent rolls and stuff like that, you know, why would you?
Because that's a tough question. I mean, honestly, it's because they can. I mean, they know there's gonna be worth more, so they're trying to get a little bit of appreciation out of there. They're gonna want, you know, if it's multifamily specifically, yeah, they just know what they're selling. They're selling an undervalued asset and they know they can do it. I mean, I mean, I agree with you, trust me. I'd much rather pay what it's worth than what it could be, but you end up finding an equal medium there somewhere. That'll change, you know, as the market changes. It's all supply and demand is what it is.
Do you prefer, do you prefer, burning out of a property or selling it off because of the tax implications? What you rather do?
It depends on market, it depends on the quality of the asset. Like if it's a great asset, I would much rather refinance out and turn it into what I call a portfolio asset, which means it kind of comes with sort of your own holdings, if you will. But if it's a good market, like, you know, ours we sold, it's a great market. It's probably the best multifamily market in, you know, past 24, 36 months that you see in a long time. So, you know, those only come around 10, 15, 20 years. So you got to capitalize while you can.
Sure.
So in that case, yeah, you take chips off the table. So.
Yeah, because you're gonna, hey, we're in this up run, I'm gonna pull equity out of the market
It's
right
all
now.
about, it's all about playing the cyclical markets. That's where it all, I mean, anybody you study that's one of the things.
But it sounds like one of the big advantages you're saying is, hey, if I'm doing these cash out refinances, there's an opportunity for all of us to have a capital event that's not taxed.
Not tax, and then you
So
take that.
we can pull this, we can defer our taxes until later, and then we're not losing 30% of our leverage here. Cool, I got out 100, I can go put 100 in another deal. I don't have to go, I sold and now I've got to pay 30% tax. Sure.
It becomes a snowball thing, right? Once you
Yeah.
start doing this, like it starts small, but once it gets going, I mean, you get to where you're getting, you know, $2, $3, $5 million cash out refis, and you take that, just bam, there's your 30% for your next one. So you just keep rolling.
That's awesome. All right, y'all. So thanks for coming out. Feel free to, I'm gonna shut the recording off here. We can hang out, we can network. If anybody talk to you, grab them before you get out of the room, exchange your contact information. If you can, leave us you can leave us a review on Meetup, but join the Meetup group, greaterknoxville.com. There's also a link on there if you go there for the mailing list, if you want to be on the mailing list for investments, for some of this follow-up stuff. Thanks for coming out. We appreciate you guys so much.